The derivatives market is starting to crack just like we saw during 2008. And remember, this is a market that's over $1 quadrillion. Warren Buffett calls derivatives financial weapons of mass destruction. I'm going to explain exactly what's happening right now and if I think this will lead to the next GFC in one simple, fast step. We've got to start by looking at CLOs, collateralized loan obligations. And if you don't know what they are, they're like a financial Jenga puzzle. And this was highlighted in the Big Short movie. Editor, cut right to the clip.
A's, 0. B's, 0. Double B's, 0. Triple B's, 0. And then that happens.
What is that?
That's America's housing market.
So what was happening in 2021 and 2022, these CLOs were really, really hot because everyone was trying to chase these huge returns. It wasn't just the cryptocurrencies or the ICOs or the meme stocks. Money was flowing into anything as long as it was extremely risky. So this guy right here wanted to take advantage of that. Who is he? Well, he is someone that they call the sponsor. And just to keep things simple, he's like the fund manager. And we will call him Slick Rick. And Slick Rick is all about the Benjis, that's for sure. You can tell because he's got these dollar signs on his glasses. And he is basically a financial intermediary. He doesn't really do any work. He's kind of like the pimp of the financial industry, where he just kind of acts as a middleman and he collects a bit of a spread there, right? So he's got his cane there because like any good pimp, he's keeping his pimp hand strong, that is for sure. So he goes out to all of these investors that have different appetites for risk, but they're all chasing higher and higher yields. And he says, look, if you give me money, I'll sell you a bond, but I'll make sure that in the fund, you get paid first, assuming that we have losses. And for this, I'll pay you a little bit lower interest rates. Says, oh, that's good, that's exactly what I'm looking for. And then he'll also go out and sell equity to this guy that's looking for a little bit bigger yield, but he's willing to take on even more risk. So then what does Slick Rick do with the money? Well, he goes out to a shadow lender. You can go out to a variety of different entities, but for this example, we'll use a shadow lender. And he says, look, shadow lender, I need some product, pronto. And they say, well, we've got a few loans on our book that we'd be willing to sell to you, or a few loans on our balance sheet that we could go ahead and part ways with. And he says, fine, give them to me. Then the money goes over to the shadow lender, and then those loans go over to Slick Rick, and he takes the loans and he creates this CLO. And he divides it into different tranches, just like they outlined in the Big Short movie. So if you're this bond guy and you want a little less risk, well, you can have this higher, let's say, A tranche at 5%. And then if you're willing to take on a little bit more, or a little bit more risk, but you want a little bit higher yield, we got something for you. That's right. But if you're like this guy and you want equity because you want this big fat 8%, well, if they take any losses, then you are going to get wiped out first. So now that we've got our head around kind of the structure as to how these things are organized, let's cut right to this Bloomberg article that shows how these cracks are starting to show up in the commercial real estate CLO market.
We go straight to Bloomberg, and the title of this article is Buyouts of Delinquent Commercial Real Estate CLO Loans Jump 210% as Multifamily Landlords Struggle. The key talking points here, lenders, which they're using the term lenders, that's actually the sponsors. This is Slick Rick, is what we're talking about here. Bought out 520 million of these loans in the first quarter. Issuers are purchasing bad loans as interest rates remain high. As delinquencies on multifamily mortgages pile up, lenders who had bundled those borrowings into securitizations, known as commercial real estate CLOs, are racing to stave off trouble. And when they're talking about the lenders, they're talking about the sponsor of the CLO, the manager that put this all together, just to make sure that we're clear. To keep the share of bad loans from spiking too high, a development that would cut the issuers off from the fees they collect on the CRE CLOs, they've been furiously buying them back. And this is according to JP Morgan. It's the latest sign of strain among the 79 billion of loans packaged into CRE CLOs, a market which grew in prominence in recent years as Wall Street financed syndicators who bought up apartment complexes with the intention of renovating them and boosting rents. When rates surged, many of the borrowers were caught off guard, and as a result, now they're falling behind in their payments. But here's where it goes from crazy to completely insane. To buy the defaulted loans, some of the lenders have been borrowing the money from the banks and other third parties using what are known as warehouse lines, a type of revolving credit. The CLOs surged in 2021, going up by $45 billion, a 137% increase from 2 years earlier. What basically happened is all of these syndicators started building these apartments or buying these apartments from all the people moving into the Sun Belt. And they thought that 3 years, which was the maturity on a lot of these loans, would give them plenty of time to do the upgrades and refinancing. But now what we've seen is the occupancy rates go down, rents aren't going up as high as they thought they would. And because the Fed raises rates, now all of a sudden the cap rates go up, meaning the value of the property they have didn't go up, it went actually down.
So basically what happened in 2021 and 2022, we had these group of borrowers that were very risky. They were going out and buying these multifamily apartment complexes or these high-rise office buildings or something like that. And they were saying, look, it's negative cash flow right now, but we're going to make all these improvements, so we want a bridge loan. And if we do make these improvements, and if the market continues to go up at the same rate, and if we are able to charge a lot more for rent, then we can go ahead and pay back this bridge loan, or we could just sell the asset, we'll pay back the shadow lender, and we will pocket the money. So they go to the bank and pitch this idea, and the bank says, absolutely not, because you are way, way, way too risky. So like I said, they go to the shadow lender and pitch him on this. And the shadow lender says, yeah, okay, I think I can go ahead and do that deal because I'm going to get this off my books ASAP because I got Slick Rick that I know will buy this loan. Well, where does the shadow lender get the money? Ironically enough, from the bank that turned down the risky borrowers to begin with. Let's just say that we can look at these borrowers as if they're a credit score. So the risky borrowers, 550, the shadow lender, a 750. So the bank won't touch them with a 10-foot pole. But they look at the shadow lender and their 750 credit score and say, well, actually, they're a good risk. Not understanding that the shadow lender is just lending to the people that they declined with the bank's money. Oh, how could this ever go wrong, right? So then what ends up happening in 2023 and 2024, when these higher and higher interest rates really start to bite and the economy starts to decline, and all of a sudden their occupancy rates go down, these risky borrowers. So not only are their occupancy rates going down, lower cash flow, but when they do have to roll over this debt, it's going to be at a much higher interest rate. So they realize that, hey, there's no way we can ever pay back this loan, so we're just going to stop making payments right now. Well, this poses a big problem for Slick Rick because you see, Slick Rick makes money on fees that are generated from this CLO, and he gets incentive fees assuming that the equity holders never have to take a loss. But remember, this requires all of these payments from the risky borrowers to be made. Once they default, now all of a sudden you've got loss risk within the equity holders of this CLO, and therefore Slick Rick not getting his fees. So what Slick Rick is doing is he's going back to the bank, oddly enough. And again, this daisy chain of risk is just really unbelievable once you unpack everything. He says, bank, I need to borrow some money. And the bank says, well, what for? He says, well, don't worry about it. I've got a 750 credit score just like the shadow lender. So the bank says, fine, we'll go ahead and give you the money. And then Slick Rick goes to the CLO, the entity. He says, well, I'm going to go ahead and buy back this garbage loan that isn't performing. So the garbage loan that isn't performing, I've got it in blue over here and red over here, indicating that over here, it's a performing loan. Over here, it's not. So he says, I'm going to go ahead and borrow money from the bank to buy this non-performing loan so it goes on my BS, or balance sheet, if you prefer. And so then the CLO doesn't have to take any losses. I can kind of paper over it really quick, and then I can collect all of my fees. Then I'll just go ahead and wait for these risky borrowers to pay. And if they don't pay, well, then hopefully the Fed will drop rates down to zero, and magically I'll get out of this unscathed. And if you think this sounds completely insane, oh, but wait, there is more. You see, if the risky borrowers never pay Slick Rick back, or if the Fed keeps rates higher, or for whatever reason this loan never performs, then what is Slick Rick going to do? Well, he's not going to be able to pay back the bank. And so what is the bank going to take? Well, they're going to take any collateral that's on his balance sheet. So then this garbage loan goes from Slick Rick's BS all the way back down to the bank that didn't want to lend to the borrowers to begin with because they were too risky. So what does that do to the bank's balance sheet? It blows a hole in it, and it exacerbates the banking crisis we're already in. So then the question becomes, is this a risk to the entire system? Could this cause a GFC 2.0? My base case, and again, there are no certainties, there are only probabilities, is that this in and of itself isn't going to cause the next GFC. But we have to look at what's happening right now in the real economy. We have to look at what the yield curves are telling us about the risk for recession, in other words, a hard landing. And right now, a lot of the economic data is starting to decline. We see the jobs numbers disappoint. We also see companies like Starbucks, McDonald's, and Pizza Hut, KFC, come out and say that the consumer is really, really pinched. So although this might not lead to the next GFC, I think it might exacerbate a recession that we would have otherwise had and make it much, much worse. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.